Thanks, everybody, for joining. We have our second episode of the new Barbarians. Bill Mann and I and our producer, Christopher Rosa, have prepared or recognized a very special day today. January 3rd, 2009 was when the Genesis block of Bitcoin was launched, and with it, a special note. Chancellor on brink of second bailout for banks. Brilliant. And what's amazing about this is not just that January 3rd, which I believe was the first day of '09, months before the bottom in the market after the Lehman failure and the other bank failures. But in October of '08, Satoshi Nakamoto released the white paper, the 9-page white paper that solved the double payment dilemma that had vexed 20 years of cypherpunks like Adam Back about how not to have a double spend occur. So proof of work, as Satoshi said, unfortunately was the only way out of it. Going into the weeds here, because it was such a sequencing of perfect timing at the right time that gave rise to, and I'm going to go back into the next graphic, Christopher, if you could bring it up, which is what happened since the chancellor said they're on brink of a second bailout. It never stopped. We had bailouts ever since. March of 23, we saw more bailouts. The Federal Reserve has stepped in and basically backstopped all banks forever. You know, Drahi back in 2012 said whatever it takes. From that moment on, we basically gave up on the investment and the economic cycle. Recessions were short. They were quickly addressed by central banks. And the result is essentially an increase in money supply and a asset inflation like we've never seen in housing, scarce goods, and Bitcoin. So I'm going to, before I hand it over to Bill and go into some of the how AI fits into this, let's go to that next graphic, Chris, on, I believe it's Bitcoin. Yeah. So here we are. We are at a critical juncture. We are in the last year of the 3 red, of the 3 green, up before the 1 red, if cycles hold. Bitcoin has a 4-year halving cycle. We're not going to touch on that. That we'll put in the show notes, maybe some references for the Bitcoin unwashed, for those not exactly familiar with the Bitcoin protocol. But just look at this. This is one reason why we believe, at least that Mr. mentions, and in our work, that we're going to have another up 150 to 450 cycle in this 2025 year. We're a bit off on the 120 was what we did in 2024, 157 in 2023. And as we know, 2022 was a down year. So this is the last year of an up cycle, and everyone's wondering, will it be different this time? We won't solve that in this call. We just want to recognize the day we have, which is January 3rd. It's the 16th birthday of the Bitcoin blockchain. Sweet 16.
Cool. Thanks, Mark. I will talk a bit more about AI and what I'm doing in particular with LLMs, but just going back over the charts, the M2 chart that just shows the Fed pumping cash over this whole period is one that obviously should resonate with everyone, but particularly with Bitcoin and crypto. And part of me is like risk on, risk off asset. Like when I look at crypto returns, they aren't necessarily always an inflation hedge. They don't behave with rates exactly how you would expect. There's definitely a risk on, risk off component. But we all know what happens with asset prices when liquidity is continually pumped into the economy, and I called a correction in the market a few times, and we've had some scares, but most of them are, related to huge events like pandemics. But yeah, there aren't a lot of corrections when, central banks globally continue to pump money into the system. So um, that's a pretty easy way for me to segue into, you know, I'm glad that my personal views about the economy and inflation didn't drive behavior at the firms I work for. So the good thing about quants is they basically bet on everything, um, and have a lot of diversification. So generally speaking, they've all done well throughout this period. Um, and in particular, like I look at 2024 um, quant performance, and surprise momentum has outperformed significantly. And you know looking at outlooks for 2025, um, I think you can still see momentum, size, uh, basically everything do continue 2024 through the first quarter. And then, momentum may slide off a little bit for the rest of the year, but, this is going to continue. And the only thing that's projected to be down is like low vol. And I don't know, it's like the party's still going. And I think that that's basically the story. I'm not sure how much that M2 is going to continue going up, but there's just so much liquidity in the system. And, I think sentiment around all assets, but especially crypto and Bitcoin, is bullish. So, at least for the next quarter, I think everyone should be pretty
That's it.
comfortable that things are going to be going pretty well. And then,
So, Bill, when you're talking about momentum and low vol, and our audience is broad, and we have lay people as well as investment professionals. Most people, if they listen to Bloomberg or CNBC, you'll hear about the energy sector, the Magnificent Seven, which are software-based firms. They'll hear about banks. How is J.P. Morgan doing? Well, rates help them. And ETFs, the passive market is growing in ginormous, and ETFs are over $10 trillion now, and most of them are passive. Why do quants focus on these funny things that you're talking about versus what BlackRock and Fidelity? They have some things like you talk about, the quant items, but they basically sell broad market ETFs. Why do quants focus on these little subtexts, and how do they make money on it versus just going along the market?
So great question, Mark. And yeah, I speak about risk factors and what we commonly call quantitative risk factors, or beta, smart beta. All these things are different versions of the same thing. So what quants have done for 20, going on 30 years now is bet on different betas that are identified in the equity markets in particular, but we've identified them in all asset classes, where you basically break down risk premia, and we call them factors. So there's a risk premium for value. That's what Graham and some of the classic value investors, that's what Warren Buffett does. So
And an example of that would be like book value. If you killed the company and sold everything at auction, all the buildings and property, plant, and equipment, what are you left with? Like that would be a base example.
Sure. And the most commonly used value factor is market to book. So,
Okay.
you look at the market cap of a company, and then if their balance sheet is accurate, you say, well, if we sold the whole company, what would be left? And, so there's a nice value component that you can very easily quantitatively measure. And then you can go long, short value. So you go longest, the best value stocks, and shortest, the worst ones. And that's commonly how these things are implemented on a long short basis to identify alpha. So you minimize market risk by going long short, and you go long short each of these risk premia factors. So there's also momentum, which is really just sentiment around stocks. You buy stocks that are performing well, and you sell stocks that are performing badly, and assume that sentiment in the market is going to continue in the same direction. And that's what's also done in managed futures funds. They're basically momentum strategies. You can bet on size. So the Magnificent Seven and some of the large market cap stocks that have been driving the big indices are what you're betting on. So if you buy the S&P 500, you're increasingly buying the Magnificent Seven. And so that size factor, I think, is also pretty consistent with what people are buying. The big difference is, and this is something that's been difficult for hedge funds for 10, 15 years now, is how do you outperform the S&P when it just goes up and up and up? So before the last 10 years, and I guess 15, you didn't hear about the S&P going up 26%, and momentum itself was up 17% last year. So just the bullish sentiment of the market has been going up and up and up, and it's, like I said, going to continue into at least the first quarter of 2025. And so hopefully that answers the question, but
it does.
Risk premia would be the
risk premia. So it's a subset. It's not just looking at a bank's earnings. It's saying, let's look at every stock through the same lens of how's its momentum. Is it getting higher and higher returns? What's its book value? What's its beta to the market? So it's giving a common benchmark besides earnings into a more calibrated approach. And quants feel that over time, these are ways to give alpha value beyond what the broader market, just by going all black, put all your chips on black or red, long or short the market. That they say it's a safer way of doing it in case there's a market correction.
Correct. And when we talk about beta, the reason why it's called smart beta is you basically break down the beta of the market into these different risk premia. This type of investing was sort of made common from Fama French at University of Chicago. So a group of academics identified these risk premia that have econometric meaning to them, and econometric just means using statistics to prove some economic theory, and they're commonly held beliefs. So value stocks should go up, even if they're not performing as you expect today. And another synonym for beta would be premia. So these are commonly known market, I should say asset pricing premia that people bet on. So, and that's why you can apply it to any asset class. Sorry, I guess I'm droning on a little bit about the definition here, but
about the definitions, which are critical, because if you can't define it, so pulling it back out, the market's gone up a lot, as you said. S&P's whatever, Nasdaq's up 29, S&P's up 23 or 24, and these are back-to-back years, and these are things that didn't normally happen. Some of my Bitcoin brothers and sisters would say, well, look at the debasement. It's averaged 10% for the last 4 or 5 years, so the benchmark is 10%. If you're not making 10%, you're losing because of debasement, blah, blah, blah. Are quant funds under pressure to try to meet a higher nominal number, to meet that 20, above 10, as opposed to a risk-adjusted number. Is there any pushback?
So I think quant funds may be given a little bit more leeway than your discretionary and fundamental managers because, um, you know, typically what a discretionary or fundamental manager is doing is identifying things that, may be beta consistent. So when I do a discretionary trade, a lot of times I'm betting on beta. Um, and because I believe that this certain risk premia is going to outperform next quarter. So when I bet on momentum, I don't typically go short as many momentum stocks, but quants have a risk balanced approach to everything. So they want to minimize, any beta that they take and only take an alpha position. And so I think they're given a little bit more leeway, but everyone looks at their statements and, when a pension fund manager is looking at his or her 401k and it's just long the S&P, they kind of wonder what are these guys and gals doing at these large funds that they're supposed to add all this value, go up and they're supposed to perform whether or not the market is up or down. And like I said, I think quants are probably given a little more leeway, but everyone's under pressure.
Got it. Yeah. I remember listening to one pensioner, Bill, who, to your point about they look at their returns, and I can get it in the S&P. If someone's delivering S&P returns, a pension can say, I can replicate that for half a basis point. I don't need to, if they're big enough, they can just have a desk that just replicates S&P without buying an ETF. They can do it institutionally. So now we're going to bring it back in. Passive has dominated. It's been hard to beat passive. And that's why BlackRock went from like even 7 trillion up to 10 trillion just by, it wasn't inflows, it was just number go up. Price of their assets went up. So the pressure, so let me talk about when we were in the green room chatting, back-to-back years, up 20 plus S&P, NASDAQ. What does 25 hold? People think earnings are going to go up. Earnings were not up a lot in 24. It was all multiple expansion. It was all expectations of AI driving. So now people think AI is going to drive expenses lower, that there'll be substitution on the expense side. Maybe, buying that nuclear plant at 3 Mile Island will really help Microsoft. I don't know, but they sure think so. How do you see AI improving quants delivery of that risk premia you just said? Is time a component? Is it scope of sample that would expand with an AI model?
So that's a lot. But let me just start off with that example about using nuclear power for AI is a classic microeconomic supply and demand thing. The demand for all AI is going up, but in particular using these LLMs that consume a ton of energy. And I would even argue that the concept of using nuclear energy or powering anything, cars, people were criticizing the U.S. for carbon emissions, and we're driving our big SUVs and everyone's complaining about that, but now these things are making that look like small potatoes, but the LLMs use a ton of energy. So the demand for LLMs and AI technology is going to grow. And so we're going to need to consume a lot more energy. So I think that that's just a classic supply and demand thing that,
Okay.
nuclear is probably the way to go. Will we save a lot of time using AI? Yes. I know I now conduct my quant research with LLM models, and I use them to write Python code. I'm sure that there are plenty of engineers who can criticize the code that comes out of these various models. one way I can quality control the code is actually to run the same prompts with multiple LLMs, and then I compare them. I kind of merge the code, and then I start using it, and then inevitably it becomes my own, and it evolves and gets better than what the LLM spit out. But they spit out a really good first shot at expressing what I want to do. And I use that example only because, those are multiple roles of, my old job. So you have engineering, and then you
Yeah.
have statisticians, researchers that are working on these things, and it will make them more efficient. I don't think it's necessarily going to replace jobs or anything, but the lower level rote things that a lot of people used to do are no longer necessary, and they're going to be not only more efficient, but they're going to be more accurate. Plugging
Yeah.
spreadsheets for investment banking jobs for 2 years is no longer the role. So hopefully it will open up better opportunities for people entering the market, but they should all become familiar with using these tools so they can outperform when they do join those roles that used to be delegated. You used to delegate the least exciting work to the newer
Yeah.
employees, and they were plugging spreadsheets, and that's no longer necessary. So I think
It's going to
expenses will
flatten
come
out.
down.
It will come down. And it seems like, I look at the law firms and what Nexus Lexis Search did for law firms. It just took out not the, well, the paralegal and the person that could charge 250 to 300 an hour, gone. Clients were like, I don't need a person to do that. You can have a technology do that. And it just flattened and forced a lot of consolidation in the legal industry. And, as far as asset management, I remember we used to get a fax every night when I was at a firm called CRT Capital in the 90s, a distress firm. And it was taking in headlines from all over the US, I don't know about the world, the US, that was related to topics we cared about. We literally got a fax overnight from this firm that would give us a feed of all news, and then we would give it out to everybody. I mean, it's the information has gotten faster, and I think the part that we're trying to do in this podcast and what AI, a good AI model like what you wrote about in your white paper, which everybody should read, I found it very helpful, is you still need a good curator. The LLM is a tool, but you still need to be that best prompter. There are still limitations. You have to know which model does what. So you still need to be that master craftsperson sitting on this new tool that used to be data out of a fax machine. Or Michael Price, the value investor, would just say, we read the paper and we talked about ideas. They brought their own LLMs to the game. But it's a different game right now. So what have you found has helped you figure out, Bill, in your process of which LLM to do? Like, how are you a curator? Why should people read your paper? Why are you a good curator? I believe you are, of the AI models.
Well, thank you very much, Mark, for the vote of confidence. As I'm aging, at times I wonder if I'm just going to be replaced by machines. And that is obviously a concept that we've all thought about, and that, it gets written about in the press. And it's true that certain things will no longer be necessary. I think the paralegal, there used to be a lot of expertise in finding, you know,
Titles.
legal, legal cases and things like that, that now, a computer and automation are just going to be
Yep.
much better at. So what I will say is my experience is still worth something, and I think it's worth a lot, because I've seen both technology and process break down many times over my career, and I do always try and emphasize process as well as technology, because both can break down. And when you're running large processes in a production setting, there will always be mistakes and things happen. You learn over time that you have to redesign a process or a technology to catch certain things that you didn't predict would
Mm-hmm.
happen. And right now, the LLMs are amazing, but they still make mistakes. And I've caught them making, horrendous mistakes. I caught, I won't even name them because I don't recall which one it was, but it was expressing opinions about interest rates next year. And I'm not even talking about like point in time issues where you can have problems with it having look ahead bias. And, there are ways to control for that in the prompting process, I believe, but you actually don't know what's going on with that huge model that's
Mm-hmm.
going to be using that nuclear energy. And you do have to review its output. I've
Yeah.
established a lot of quality controls that I've written about, which are just from my own experience. When I find two LLMs giving me different answers for the same question, I know something's wrong. And so I investigate it, and then I work on my prompts. I might compare it to a third LLM, or I'll, synthesize what they agree on, and identify where the differences are, and then feed that back in, and ask it more questions. So the process that you need to still go through from a quality control perspective is very onerous. And I think the expertise that people with experience with these tools and technology and process is going to be a differentiator, and hopefully these tech startups and different adopters of the technology will recognize that. And you can't trust them.
Yeah. Yeah. Back to source documents and verification. Back to process, right?
Right. And this gets back to what I did a long time ago, reconciliations. And at a securities firm, like, you would have to make sure that you actually own what you say you own. And you didn't always, that wasn't always the case. So you'd have to go back to the bank and make sure that you actually had what you were saying you had. Your books in your portfolio could be out of whack, and you might be making decisions with bad information, bad returns, bad exposure data. So the process that we've all built over many years is still very necessary. And I think
Mm-hmm.
it would be very dangerous to just trust AI. And AI is such a broad term anyway, but LLMs, um, there's supervised and unsupervised machine learning. I think that that's an important distinction to make. If you were to just trust unsupervised processes, you're not a good fiduciary anymore.
Yeah.
Like, you need to actually supervise this electronic or digital analyst. Let's say that you are comfortable replacing certain processes that used to be done by humans. You still need to supervise them the same way that we were all supervised when we started off in our careers. And then you end up working your way up in the old Wall Street firm, where you would be
Yep.
an analyst, an associate, and then a vice president, and then senior vice president. And eventually a managing director needs to approve higher risk items whenever there's uncertainty around something that the junior personnel are less comfortable with. They always have to escalate things. And I think
Yep.
that entire process needs to stay in place. You can
And Bill,
automate
that's
some of it, but not all of it.
you don't, and then it's trust but verify. And this is why people are really excited about blockchain and AI, because what you just said about the process, think of how we kicked off our show with the Genesis block. That, what Chris showed us in that outtake of the London Times, an analog view of what was shared with the world about the exchequer saying that on the brink of second bank bailout. That was also embedded in the first Bitcoin block that now happens every 10 minutes. Immutable. It's still there. So if AI, which is supposed to, search everything, can actually search a blockchain and verify and bring in data from a blockchain which has been verified, that actually collapses your process a great deal if you can use a tool and direct it to an immutable ledger. Holy moly. We only have one real immutable ledger now, but I mean, am I going like generations ahead of that, or what could be?
No, in fact, and I spoke about this last time when I learned about the smart contract. I didn't even really like the name smart contract. I don't know, it sounds
I
corny.
agree.
Um, but when I learned about what it did, and like I said, I no longer needed to use the fax machine and going back to these old ways. I learned the hard way that it's very important to confirm details, and computers are extremely good at that. And digital technology will replace any of that inefficiency that we all agree is totally unnecessary.
Mm-hmm.
um, so that exact example where you verify and it's automatically verified and everyone's confident that it's going to do a much better job than humans, and manually reconciling things, uh, it, in my opinion, is absolutely going to replace what used to be a lot of process with little technology. And then I think with matching systems and the whole reconciliation process with securities got a lot more efficient with
Yeah.
technology. But now you can actually validate and verify down to the contract details electronically. So of course that resonates with me, and I think that it's a no-brainer that's going to take over.
Yeah. So this is a bigger thought. We can bring it up next time. But we both came from large financial institutions. You were at AIG for a while. You were at Arthur Andersen. I was at Smith Barney. I was at Credit Suisse. One got eaten, one got spat out. I mean, Credit Suisse got eaten and then basically half spat out in the forced merger with UBS. And I don't think banks can make the transition to a more efficient platform because of the legacy systems that run it. I don't believe that they can change the tires on the car as it's going around the track in our current financial system. So I don't know what your take is on that.
I wish I knew off the top of my head what the typical spend on technology was for like a JP Morgan, but it's many billions of dollars. So they are changing the tires while the car is moving. um, and systemically important, too big to fail institutions will be around throughout my lifetime, I think. So but will there be disruption in pieces of the pie? Certainly. I think you can go just look at transaction costs for trading stocks and things like that. They're just gone now.
Yeah.
And a lot of that is, yeah, it's just technology. You can do things faster and easier on your phone than certainly you could have done them 10 years ago with a really hot computer with a nice online brokerage interface. um, and I think you're right that large institutions are going to take time to upgrade everything, and some will be better than others.
Yeah.
Some may go away, and the concept of technical debt is very, very costly, and we can even make a segue into bonds and high yield bonds, and paying high coupons for that debt. And you know when you think about the balance sheet of a technology company, and that's increasingly fintechs and finance companies, if they don't actually upgrade their technology, they will be stuck with a debt burden that is in the
Yeah,
form of this, legacy process and code uh, will take certain places down, and you
that's a
have to
great
actually,
analogy,
you know,
Bill. Man, I'm gonna that because we all know, the hot topic was about the U.S. debt, 36 trillion plus, growing $1 trillion every 100 days, and interest expense now being the second largest component, more than defense after mandates like healthcare. And what that is it's funding a previous spend. It's funding a legacy, which, maybe the government made a great investment. Like, did they buy the Louisiana Purchase or Alaska? No, they didn't. You know, bridges to nowhere, unfortunately. So it's not, it had, malinvestment is alive and well in the government. And
and we still have low
in,
rates, on a relative basis for that
we have low
high debt
rates.
burden.
We do have relatively low rates, although the coupons are going higher because we're rolling off that holiday period of zero rates for 10, 12 years. So there's
Well,
seven. What's
it,
that?
I was going to say back in my day, people used to charge higher interest for less, worse credit,
Forward credits.
and the United States, you saw the chart. More debt is usually bad for credit, but I don't think the coupons really reflect the
No,
increased
but let's
credit
let's
risk.
let's go back to what you're talking about with banking is that if we're funding a poor system, like a legacy system with current dollars, that's going to be a road to nowhere. And, I bring out my poster child for malinvestment, which I think is Citibank, where the stock in 1993 was higher, all stock adjusted, split adjusted, than it is today. So if you put all your money in Citibank and said, what can go wrong in 1993? You actually lost money, not accounting for, maybe the 2.5% dividend, which, didn't keep you up with inflation.
I recall some dilution taking place when banks were paying back their TARP loans and things as well. So
Well, yeah, they had to. You mean as far they took charges, or did they just have to issue more shares?
yeah, I think they were just issuing equity and paying the
Yeah,
government back with it.
they issued equity, and Citibank had that reverse 10 for 1 off 99 cents.
Right, which is appropriate. The shareholders should pay for those loans back to the government for the bad decisions of management.
Yep.
However, I'm not sure everyone remembers and really thinks about the risk they're taking on when they buy equity in companies, and the fact that that can happen.
Yeah, and back to what quants do with size, I was thinking about that. Citibank's pretty big. It's not a mega cap, but it's a pretty big company. You'd say, hey, what can go wrong? Being around for a long while and persistent, the Lindy effect isn't enough. I think maybe we should develop a new metric about technology, about, AI impact or something like that, Bill. In our spare time, we'll get, maybe bring Chris get his software skills back into the fold here. Because, I mean, is there a factor that looks at a company and says, how efficient is its technology spend?
There are, so yes and no, and this does get back to when I was going on and on about risk premia and these known effects that are broadly applied to all stocks. Quants and fundamental managers obviously bet on sectors, and they understand a lot about companies within them. So return on equity or return on investment capital, these are concepts that get to the efficiency of managing investments with your capital base, or your balance sheet. And tech companies are interesting because their balance sheet may not really mean much. The code and their real assets are people, and then a code base. And of course there are multiple code bases and business lines, and some are worth more than others and things like that. But you don't actually capitalize the assets on your balance sheet and then
Yeah.
depreciate them. Um,
No,
and
they go up and down with the elevator is the old time what we used to say about tech companies.
right. Um, and so people are betting on earnings growth, and the tech bubble. We remember you know multi-billion dollar valuations with companies that had like no revenue and certainly no earnings. Um, so that there are ways to efficiently look at it, primarily outside
Got
of
it.
tech, but I think that balance sheet concept is going to apply everywhere. Everyone's adopting AI, everyone's investing heavily in tech. Some are going to do a good job, some are going to do a bad job, and it's going to be up to discerning analysts to figure out when a company makes a good or bad decision. It's not going to be obvious anymore that you finance a bad project with high yield debt, you used to go out of business. Now, you know, you might not really see the debt or the assets. And again, it gets back to this concept of levering up with technical debt and failing to pay off what was a good project becomes a bad project like every 5 years when you make that analogy. So code bases need to be rewritten and upgraded. Just look at what
Mm-hmm.
happened with natural language processing and the advent of LLMs. Companies that are still relying on their old natural language processing technologies are probably still doing okay, but they've been completely disrupted. And if they didn't recognize that early on, they will underperform and eventually go out of business.
Yeah. It it seems like a tech company almost has to be a venture capital, have a bunch of different businesses or investments and incubate for their processes over time, whether it be um, something like, I guess, is Musk going to bring out a new model, or is he going to put his attention on cutting expenses on the last two models? He hasn't had a new one in, I guess, 2 years. What the new one is a Q, I think, model. Is that going to come out, or will he rely, on the X to be, cost cutting on the X in order to drive margins and stock prices? Um, so we're getting on time here. What are your predictions? First of all, what would you tell the audience to go read? And where do you think we're going to be in 25 as far as in your domain of what investment firms will be looking for in a professional, or where do you think markets will be?
So I was distracted for a minute because that limit sell that I told you about before we started just hit. Um, the
It got hit.
I guess that crypto is going to do well. It's going to be really volatile, especially when you get into altcoins. And that's some of what I'm doing is trying to find arbitrage opportunities, like really trading futures and things that I didn't really do. Computers always did for me, but in some ways I'm returning back to the roots of the old ways and staring at charts and things like that. But regarding the outlook, I think Q1 all assets are going to continue going up. From a quant risk premium perspective, I think things will basically continue to be the same, at least for the quarter. And then outlook for all of 2025 is still good, but it's there's obviously more uncertainty the further you go out. And I think momentum in particular has to at some point the gas pedal, like people have to take the foot off the gas pedal, and there will be more opportunities for value investors and classic stock pickers to make money, as opposed to just buying indexes and hoping that everything continues to go up the way it has been.
Okay,
Um,
so you think there'll be distinction.
and and
The one measure. Oh, what was that?
Yeah, I was just going to say, in terms of what do you read, I actually try and aggregate as many opinions as I can from the experts. And that's, part of my tactical outlook process is I gather, you know, 30 reports from the sell side and buy side. I put them into an LLM. I synthesize all of the ideas, and then after I've sort of aggregated all of the expert outlooks, I then take a look at it myself and then start my own process, which is a few days behind as of today. But, shortly I think I'll have a more coherent outlook for cross assets in 2025.
Well, if I was going to turn that, first of all, thanks for that. As you say, with the distinction among markets, we're talking about software and tech companies have less hard assets, more people or assets. So the balance sheet shows a non-tangible versus a tangible. In the old days, we called that measure degree of tangible versus intangible Tobin's Q. And now it's popularized as a Buffett measure of a different way of looking at it, of, I think, GDP, which is a kind of a measure of real transactions under equity market capitalization. So how is the financial economy, the equity market, moving versus the real economy, which is products and services and transactions in the form of transactions? And that number, I think, is at all-time high, 2.2. It used to be somewhere between 1 and 1.5 for a long time, or below 1. And so when you say that, there'll be distinction, do you think that measure of equity market capitalization to GDP, how does that factor in? Or is that a different way of looking at it versus opportunities within the equity sector? Can value companies really bring the same opportunity as an NVIDIA?
Great question. So I do think about those sort of market-wide measures, CAPE and Tobin's Q and some of these other. I like the classic analogies because I think they always apply, especially when you look top down. I think that those are important when you take a view of the overall market and say, where do I think markets are going regionally and then within sectors. And I think it's always important to have that top-down view of everything. And then, bottom up, I think that's where, stock pickers make a difference. And once everything stops moving in unison, and I don't want to, get into correlation and other, quantitative types of, and that's just, statistics, that's not quantitative. But once co-movement, comes down and momentum is no longer the driver of everything and size is no longer the driver of everything, I think that's when stock pickers make their money, and
okay.
Hopefully they can make money on the short side too, which has been very difficult for many years.
Yeah.
But yeah, how do you distinguish NVIDIA from its competitors? Which of its competitors are actually going to compete? I don't think NVIDIA is going to be the only player in town. This is, again, a very classic microeconomic phenomena that, copycats are going to be, jumping on that bandwagon. And, maybe eventually NVIDIA is not reinvesting fast enough in its tech. So we'll have to see. But those are the types of things that I would keep an eye out for. Like, how are they making good investments today? Obviously, the good investments of yesterday have paid off very well for a company like NVIDIA. But,
and it was a long time coming for those guys. There's a video I suggest people look at. If you look, I think it's 2008, and where the NVIDIA team said, here's what our current GPU can produce as far as an image. And it shot paintballs in a smiley face. It was in a series circuit, think of a Christmas tree parallel versus series. It was very linear. And they said, here's our new model. I forgot what they called it. They might have called it Mona Lisa. And it just shot all at once, all these balls, and it replicated a digitized picture of the Mona Lisa.
That's pretty cool.
And it said, this is where we are. This is where we are now with the smiley face, and this is where we're going. But that was 2008. And it took them that long to integrate software into their hardware circuits.
Well, I also remember around that time, analysts were criticizing Amazon for having negative free cash flow. It was investing a lot in new technologies, and I think the stock price was suffering a bit because there wasn't a lot of belief in things like the cloud. So hindsight's 2020.
It is. It is. I remember hedge funds. I was at Credit Suisse. We had a group that dealt with hedge fund infrastructure, speaking to them. And the feedback was hedge funds will never go to the cloud because they give up sovereignty and control. Isn't that funny?
Oh, that it took a long time to adopt. And, lo and behold, the security is better in the cloud for the most part.
Yeah.
But
I mean, people weren't going to buy shoes on the internet. That was an old 2005 dynamic. Who the hell's going to buy a shoe?
It wasn't just fear of like hackers getting your data. It was also, do we want to share this with Google or Amazon or Microsoft? And inevitably, they did solve those problems pretty well. And now I would certainly not recommend for a startup hedge fund to build a lot of on-premises servers. But back in the day, that was a competitive advantage.
Stick to your knitting. I'm going to leave it with I'm going to pair your prediction about stock pickers when correlations change and distinction occurs among names. I think that's close to happening if the tariff fears break out. I'm looking at the dollar chart right now, which almost breached 110. I don't think it breached 110 today. But the only time it's been higher than this in the last 10 years was in September of 22, when Liz Truss was forced out of office after a brief 44 days, almost as short as Scaramucci's press secretary days under Trump. She was forced out, like you had to go back to 1640 when a prime minister served, something like that, a shorter period, because they had pensions going under. Bank of England had to step in, and she wanted to basically have an austerity program that would starve them. And her whole cabinet and administration got thrown out. Why? Because of a strong dollar. The dollar hit 114 at that period. Rates were rising, very disruptive. The dollar is a wrecking ball, a strong dollar. And if Trump and the administration doesn't get it in order and back under, I would say 105, under 100 pretty soon, you're going to see more problems like what you see in Brazil. You're going to see more problems globally, and you're going to see a market disruption. It'll be short-lived because, as we said, we can't handle it. So, there'll be the Fed foaming the runway to prevent all planes from crashing and going on fire with more money. Well, that about wraps up today's podcast for the new Barbarians, everybody. Thank you. Before we kick off, though, for the week, we do want to leave you with a few predictions for 25. And if there's one metric and one market that I think is critical to watch, it's the dollar. In particular, what they call the Dixie, the DXY index, the dollar index, the dollar against major currencies like the euro, the yen, the pound, the Canadian loonie. And as we write or speak now, it is at 109, almost breached 110. And except for the period in August, September of 22, when the dollar went as high as 115, is that right? Here, I'm looking at my little Bloomberg screen. As high as 115 rather, when, remember, the Bank of England had to bail out some pension funds in England because they were on the wrong side of rates. And Liz Truss ended up being one of the shortest living prime ministers. I think it was 44 days. You had to go back to like the Middle Ages for when a prime minister had a shorter period. It was barely longer than what Scaramucci was as a press secretary for Trump in that first administration, unceremoniously taken from office. Why? Because markets went awry. When the dollar goes strong, other markets fail. It causes pressure because dollar-based debt goes higher. Emerging market countries can't afford to pay it back. Their currencies drop. And in particular, what I think what Bill talked about with unique stocks, if the dollar goes higher, it'll be a stock picker's market. That's the first point. The second point, dollar goes higher, things break. The Fed will step in, and that M2 graph that we showed you will take another leg higher. It will be like the bank failures of 23 or COVID in 2020. So look for tariffs, look for driving the dollar higher. That's a problem. Regardless, our team at Risk Dimensions has put out predictions for Bitcoin. My second point away from the dollar for 2025, Bitcoin we have at 250 to 450,000 based on the behavior of prior halvings, as well as what we think is the global liquidity model, which we think will expand regardless of a dollar break or not. So that's it. Dollar, watch it. It'll create disruption. Regardless, Bitcoin goes higher. Bill, I know you've done your own work and published some outlooks for 25. What are some top ones for you?
Cool. So right off the bat, I think we're in agreement with the backdrop, and I'm still doing my work with the multi-assets, but we do have an outlook on Bitcoin at 250. So, I think we're sharing the bullish sentiment across crypto as well. But yeah, please take a look at how we built a bottom up for Bitcoin at 250. And then, rate cuts, are slowing down, but those are going to continue driving the economy. And, earnings growth, like we mentioned, small caps and cyclicals should be leading. In fixed income, I think we want to be careful. And in particular, some of these risks that we're talking about, so selective in the yield space. And the similar way to, I think we're going to focus on quality stocks if some of these risks start to materialize. So credit risk at least will come back and be a differentiator of some sort. Credit cycles are kind of gone, but I think the stock pickers should be looking at things like quality of earnings. Balance sheets will become more important, and especially in like the high yield space, I think there will be some more risk if some of these additional concerns materialize. And like you said, if there are problems with the dollar, that's bad for everyone. In emerging markets, I think we're going to keep an eye on China stimulus and see how well it helps. It's not like in the U.S. where it's pretty easy to just pump the economy. But I think we actually went from a pretty bearish outlook on China to a bullish one like overnight. It was almost embarrassing to feel that way, but that's what happens when central banks come out overnight with a announcement. And where else were we? Small caps and cyclicals, I think risk on, but increasingly quality and value will be drivers for single stocks. And I think we'll have a more cohesive outlook across sectors and regions, next time we catch up.
All right. Look forward to hearing about it. Thanks, everybody. Until next week.